will this sluggish real estate market ever get moving again? I mean, at this point, the whole thing is more sluggish than Jabba the Hutt after Thanksgiving dinner. Housing transaction volume has slowed to a crawl. Appreciation is only about 2%, and rent growth, it's like barely doing push-ups. I coined the phrase real estate pays 5 ways back in 2015. Yeah, but how does that hold up in today's slow market? We'll take a look. Hi, I'm Keith Weinhold, Get Rich Education founder, Forbes Real Estate Council member, and see my work in the USA Today. Would an income property buyer's return be disappointing if they bought now? Well, let's do it. Let's determine what you could realistically expect if you purchase an investment property here going into 2026 market conditions. We'll determine your total rate of return in year one. Now, Redfin recently reported that year-over-year home prices rose about 3%. Not too impressive. Others say 2%. Let's just be conservative and use 2. All right, say that you buy a $200K single family rental now. A 20% down payment means you're putting $40K down. And sellers are willing to give you concessions now. All right, say they'll pay your closing costs because the $200K you're paying is their full asking price. Their price, your terms. We'll say that you won't get any cash flow. The rent only covers the expenses exactly, and here we go. In a slow market, the first of 5 ways you're paid is that erstwhile appreciation. Your property only appreciates 2% from 200K up to 204K. Not very exciting at all until you realize that your return is your gain on your skin in the game. So your 4K gain divided by your 40K down payment gives you a 10% return on investment. Yeah, there it is. Leverage didn't just show up here, it brought donuts. 10% from the first of 5 ways you're paid. The second way is cash flow. Say that rent minus your 160K loan's mortgage payment and your operating expenses, that merely breaks even, 0%. So you've got 10 from appreciation plus 0 from cash flow. We're up to 10% total. And before we add on numbers 3, 4, and 5 to get your total rate of return in a slow market, let's check on Jabba. Nope. Jabba still hasn't gotten up from that heavy Thanksgiving dinner. It's a slow market, so let's continue. The third way you're paid is with that ROA, return on amortization, with a 7% mortgage rate and your 160K loan on this property. An amortization table shows you $1,625 of tenant-made principal paydown. Divide that by 40K, that's another 4% return. We got a 14% total now. Fourthly is your tax benefit. It's a 150K structure value. Since raw land can't be depreciated, times 3.6% depreciation means you have tax sheltered $5,400. This is like a phantom loss. A little more math here. At a 24% income tax rate, that's $1,296 saved. On a 40K down payment again, that's another 3%. Your running total is a 17% ROI. Before we get to the last one, which is inflation profiting. It is not inflation hedging, which a lot of people mistakenly say in real estate. Almost everyone does. It is inflation profiting. Your 160K loan gets eaten by $4,800 at a 3% inflation rate. Divided by 40K down. Inflation is usually the villain, and look, now it is the hero. 12% from inflation profiting, and here we go. Here's the sum. Your total year one rate of return is 29%, and you're kind of like, did that really just happen? Especially if you're new to this. And I've got to say, before I ran these numbers here in this slow market with 2% appreciation and 0 cash flow, I kind of thought they'd be in the low 20s, not this high. But the numbers don't lie. They just don't get enough attention on CNBC. I've got more on putting this into perspective for you, but first go ahead and put a like on the video if you like how I'm breaking it down here, and thanks in advance for the thumbs up. I used shorthand and simplified. You'd also have to adjust your 29% return for inflation, so then a 26% inflation adjusted return for you. And if you haven't seen it, I shot a 5-part video series series, one for each of the 5 ways that explains this more. But the huge lesson and epiphany here today is that it doesn't take a high growth market to build wealth. Even when it seems like real estate's half asleep, it can still work 5 jobs for you. This could be the nadir of the cycle. Appreciation has picked up these past few months, and mortgage rates are lower than they've been in a while. This is all really sort of like dating someone. To really get to know them, you want to see them at their worst or be sure that they look good on their bad days. Even when appreciation and rent growth slows, the ROA, tax benefit, and inflation profiting just keep working overtime. And though I'm calling today's market conditions slow, others that are more optimistic call it a healthy market now, saying that we're having the healthiest market since the pandemic because with supply up, there is this better balance between buyers and sellers than there was 4 and 5 years ago. So the bottom line here is that income property still pays a lofty 29% if you buy today, just assuming with typical conditions, even in a slow market. And this is at a time when investors don't know what to do with their money since every market type nearly seems to be close to an all-time high, and savings accounts pay you less than a gumball machine. Owning investment property proves its resilience. I mean, really, that's why we do this. Your wealth quietly compounds in the background while the rest of the world debates interest rates on LinkedIn or panics about something. I would like to think that the 5-part Real Estate Pays 5 Ways video series is the most important collection on investment education out there. I just reshot it all this year. This is course level instruction straight from me, but it's 100% free. You don't have to leave an email address or anything. Start with part 1 out of 5 here, and part 2 is right here.